Imagine for a second that you are 31 years old.
Okay.
You have just sold your very first company, and the check clears for $3.35 billion.
That is, yeah, that's a number that's hard to even wrap your head around.
Right. Take a moment to really process that. $3 billion. You have absolutely no obligations to anyone. You could do literally anything you want.
Buy an island?
Exactly. Retire, buy a private island, disappear, never look at a spreadsheet again. Or, I mean, if you're the kind of person who just has to keep working.
Which a lot of these founders are.
Right. You could waltz into Silicon Valley, snap your fingers, and start some massive, shiny new tech venture. You'd have unlimited backing.
Instantly, they throw money at you.
But instead of doing any of that, you decide to take a massive chunk of your personal fortune and pour it into a failing mall-based video game retailer.
Yeah.
A company whose stock is trading at around $4 a share.
That's why.
A company that the entire financial world, I mean, every pundit on television, every analyst on Wall Street is calling completely delusional. A relic of the past.
Yeah.
The absolute, undisputed next blockbuster.
Yeah.
Why on earth would anyone do that?
It's one of the most mind-boggling scenarios in modern financial history, really, when you look at it from the outside.
It really is.
But peeling back the layers on that exact question is exactly what we're going to do today.
Welcome to today's Deep Dive. I'm your host, and if you are joining us, we are unpacking a fascinating stack of excerpts from a recently published book.
Really incredible book.
Yeah, it's titled The Next Buffett: How Ryan Cohen Turned a Failing Retailer into a Permanent Capital Machine, written by Arthur B. Sterling. And I have to tell you, going through these notes, this doesn't read like a typical business book. It reads like a financial thriller.
It absolutely has that pacing, and I'm here to help break it all down. Our mission for this deep dive with you today is twofold. First, we're going to unpack Sterling's meticulous investigation into exactly what Ryan Cohen saw that the rest of Wall Street seemingly missed.
Right. The hidden value.
Exactly. We're going to explore this idea of the Buffett playbook.
The source material we are covering today makes some very heavy, highly specific claims about Wall Street practices, hedge funds, consulting firms, and the entire structure of the market.
That is a crucial point to establish upfront. We are here today to report impartially on the contents of Sterling's book.
Exactly.
We are not endorsing these viewpoints, and we are certainly not taking sides in any political, economic, or financial debates. Our goal as your guides is simply to unpack the fascinating financial mechanics and the structural allegations exactly as the author has detailed them in the text.
Just laying out the facts as presented.
Right. We are exploring the ideas, the data, and the evidence he presents so that you can fully understand the arguments being made.
Exactly. We're just here to help you navigate the material.
Yeah.
So to understand what actually happened with GameStop, the author argues we can't start in 2020.
No, you have to go back.
We actually have to look at two completely different times and places to establish the blueprint. On one hand, you have a 25-year-old Warren Buffett in a 1956 Omaha sunroom. And on the other hand, you have a 25-year-old Ryan Cohen in a noisy Montreal apartment in 2011. Help me connect these two dots.
It's a brilliant parallel that Sterling draws to set the stage. Let's look at Buffett in 1956. He had no official office. He had no secretary.
Just the guy in a sunroom.
Literally sitting at a card table in a borrowed bedroom. He was sorting through massive stacks of physical corporate annual reports.
The old school way.
Yeah. He had raised roughly $105,000 from a handful of friends and family members, and he was formulating a very specific theory about how markets systematically misprice value.
Right.
He wasn't out there promising people standard market returns. He was promising excess returns by buying, as he famously phrased it, dollars for 50 cents.
Right, the classic value play.
He firmly believed that if you had the patience to wait, the market would inevitably be forced to recognize the true mathematical value of a business.
Okay, so that's the classic value investing origin story. But fast forward 55 years to 2011, we aren't in a quiet Omaha sunroom anymore.
No, far from it.
Ryan Cohen is in a cramped studio apartment in Montreal. And according to the book, the inciting incident for his entire empire is that his toy poodle, Tylee, is barking at the door because a delivery of premium dog food is late.
Which is such a mundane thing.
Right. He had paid $65 for a bag of dog food online that he could have bought for $45 in a physical store.
A huge markup.
He paid a $20 premium purely for the convenience of having it show up at his door. But because it's late, That convenience is entirely wiped out.
Exactly. And from that incredibly everyday frustration, Cohen starts doing the math on the pet supply industry. And that math is where the next Buffett comparison really begins to take shape in the book.
Because he sees an opportunity.
Right, but you have to remember the context of 2011. At that time, the e-commerce pet space looked like an absolute graveyard to investors.
Because everyone still had PTSD from the dot-com bubble.
Oh, absolutely.
The spectacular failure of Pets.com in the year 2000.
Yep.
The sock puppet.
Precisely. No venture capitalist wanted to touch pet e-commerce with a 10-foot pole. And, their logic made sense on the surface.
How so?
The product is physically heavy, it has notoriously low profit margins, and shipping a 40-pound bag of dog food across the entire country is incredibly expensive.
It eats up all the margin.
Right. It looked like a structurally flawed business model. But Cohen, looking at this space, saw something else entirely. He looked past the upfront shipping costs and became obsessed with a metric called lifetime value, or LTV.
Let me make sure I'm wrapping my head around this.
Yeah.
Because a dog lives for, 10 to 15 years?
Generally, yeah.
So if you are a customer spending $50 a month on premium food, that is $6,000 to $9,000 over the dog's life.
But just on food.
Right. Add in treats, toys, a new bed every couple of years, medications.
Yeah, it's up fast.
You're easily looking at a $10,000 lifetime spend per customer.
That's the exact calculation. So Cohen's thesis was incredibly simple but mathematically powerful. If you spend, say, $50 to acquire a new customer.
That's the CAC, right? Customer acquisition cost.
Yes, your CAC. If you spend $50 on CAC, but you provide an experience so phenomenally good that they never leave your ecosystem, the unit economics over the long term are just extraordinary.
They just keep paying you year after year.
Staling points out the parallel perfectly. Buffett bought dollars for 50 cents. Cohen was buying customers for $50 who were mathematically worth $1,000 in gross profit over a decade.
Ah, I see.
It's the exact same fundamental value bet, just using different variables.
That makes sense in theory.
Mm.
But pitching a 10-year payoff to a venture capital firm in the age of rapid software scaling sounds like a nightmare.
Oh, it was brutal.
And the book has a great story about this. In the winter of 2013, Cohen travels to Boston to meet with Larry Cheng at Volition Capital.
Right.
Now, Volition specialized in e-commerce, but they'd already passed on every single pet supply pitch that had ever crossed their desks.
They hated the sector.
So Cohen walks in with this modest 12-page slide deck. His company, Chewy, is growing fast. They're on track for $100 million in revenue, but they are burning through cash at an alarming rate.
And Cheng basically shoots him down right there in the room.
Just flat out.
Pretty much. He tells Cohen that trying to compete with Amazon in a low-margin category, selling heavy, unsexy products, is one of the worst business models he's ever evaluated.
Wow.
And from a traditional VC perspective, Cheng's logic is sound. Let's look at the numbers. Chewy was spending roughly $80 to acquire a customer,
Okay.
but they were only making about $40 in margin off that customer in the first year.
So they're losing $40 a pop.
Exactly. On paper, that is a mathematical hole you can never climb out of. If it costs you more to get the customer than you make from them, scaling up just means you go bankrupt faster.
Because you're just multiplying your losses.
Right. Cheng tells him nobody stays loyal in e-commerce. Customers just click away to wherever the cheapest deal is. So Cohen leaves the meeting with absolutely nothing.
But this is the part I love, because it shows how methodical he is. 6 months later, Cohen doesn't send an angry email. He doesn't come back with a flashier marketing presentation.
No, he brings data.
He goes back to Larry Cheng, walks into his office, and just opens a single Excel spreadsheet on Cheng's desk. It wasn't a pitch. It was a cohort analysis.
Yep.
Can you explain exactly what a cohort analysis is and why it changed Cheng's mind?
Sure. A cohort analysis is essentially tracking a specific group of customers over time to see their behavior rather than just looking at overall revenue.
Okay, so a specific batch of people.
Right. Cohen tracked the exact 1,000 customers Chewy had acquired in January of 2012. He showed Cheng the hard data. Yes, in year one, we paid an $80 acquisition cost for these people and only got $45 in revenue. We bled cash.
The hole they were talking about.
But in year two, that exact same group of customers didn't leave for Amazon. They actually spent $120 with us.
Oh, wow.
In year three, that same group spent $180.
Hold on, so the cohort wasn't shrinking. Usually you expect a certain percentage of customers to drop off every year.
Yeah.
Churn, right?
Exactly. Churn is the killer.
But you're saying the value of that specific group was actually
expanding significantly, because they started by just buying the heavy dog food on auto ship. Then, because the service was so reliable, they started trusting Chewy for the high-margin items, the toys, the treats, the winter coats for their dogs.
The profitable stuff.
Right. The retention itself was the moat. Once Chang saw that these cohort curves were all pointing up and to the right, he realized Cohen wasn't pitching a hopeful theory about loyalty. He was holding mathematical proof.
The numbers didn't lie.
Volition Capital wired them $15 million 2 weeks later.
That's incredible. And how did he actually build that retention? Because to Chang's original point, you were competing against Amazon.
The everything store.
You can't compete on price. Amazon will just bleed you dry. So Cohen decides to compete entirely on customer experience, but he does it to an extreme degree.
Very extreme.
The book says he treated company culture not as an HR talking point, but as a literal budget line.
Yes, and Sterling tells a highly revealing story about Cohen in the shipping bay at 2 a.m.
I love this one.
A forklift operator accidentally tips over a pallet, and 50 bags of dog food hit the concrete floor.
A mess.
In a normal corporate environment, the executive team is asleep, and the night manager maybe logs an incident report and leaves it for the morning shift.
Right, they deal with it tomorrow.
Instead, Cohen, who is physically there in the warehouse, personally starts restacking the heavy bags himself.
The CEO.
Yes.
Yeah.
Why? Because a customer had ordered that specific food 3 days ago, it was already delayed, and the dog needed to eat.
It's just brutal, grinding logistics. It's not the glamorous Silicon Valley startup life with ping pong tables and kombucha on tap.
Not at all.
It's moving heavy bags of kibble in the middle of the night. But the story that really blew my mind was the flour policy.
The flowers, that's legendary.
A customer service rep gets an email from a woman who wants to cancel her auto shipment of dog food because her golden retriever had just passed away.
It's a heartbreaking everyday occurrence in that business.
Right. And Cohen personally looks up her account, sees she's been a loyal customer for 18 months, and he orders her a $60 flower arrangement with a hand-signed condolence card.
Which is a lovely gesture.
It is, but his customer service manager immediately balks at this. They pull him aside and say, "You can't do this. That $60 just wiped out all the profit we made on her account for the last year and a half."
Typical middle management thinking.
And Cohen not only shuts the manager down, he empowers every single customer service rep in the company to do the exact same thing.
Everyone.
Send flowers, issue full refunds without manager approval, overnight late shipments at a massive loss.
And if we connect this to the broader financial picture, this was absolutely not charity. As Sterling meticulously notes, it was a highly calculated investment in retention. Think about what happened next. That grieving woman posted a picture of the flowers on social media.
It went viral.
It went totally viral. It completely cemented the brand's reputation as a company that actually cared about the pet, not just the transaction.
Yeah.
Every $60 flower arrangement was a direct deposit into the company's competitive moat.
It bought loyalty you couldn't get with ad spend.
Exactly. Cohen understood exactly what Buffett understood decades earlier about brands like Coca-Cola or See's Candies. Trust is a financial moat. It drastically reduces churn, it massively increases lifetime value, and it makes the unit economics hum perfectly over a decade.
And boy, did those unit economics hum. In 2011, Chewy had zero revenue. By 2017, just 6 years later, they had reached a $3.35 billion valuation.
Unbelievable growth.
That is a compounding growth rate of over 200%. But the exit is what truly sets up the entire GameStop saga.
This is the pivot.
Right. In the spring of 2017, PetSmart comes along and offers to buy Chewy for $3.5 billion in straight cash. Now, Cohen's advisors and bankers are screaming at him not to take the deal.
They wanted the IPO?
They are practically begging him to do an IPO, take the company public, and they project a $5 or maybe even $6 billion valuation on the open market.
Which means huge fees for the bankers.
Of course. But Cohen says yes to PetSmart and walks away. Why leave billions on the table?
Because, once again, he was operating from Warren Buffett's playbook. You have to look back at 1969.
Okay.
Buffett had been running these incredibly successful investment partnerships, crushing the market for over a decade. But at the absolute peak of his success, he shut them down and returned the capital to his partners.
Why would he do that if he was winning?
He didn't do it just because the market felt overvalued. He did it because the fundamental game had changed. The environment was shifting, he couldn't find the deep value bargains anymore, and he recognized it was time to step back rather than force bad investments.
And Cohen saw a similar environmental shift happening in e-commerce.
Exactly. Amazon had just launched Amazon Fresh. They were clearly making a massive, multi-billion-dollar push into grocery delivery, and the logistics for delivering groceries are identical to delivering pet food.
Ah, the refrigerated trucks, the fast local delivery.
Right. Pet supplies were inevitably next on Amazon's hit list. Cohen knew that competing head-to-head with Amazon's essentially infinite pool of capital would eventually mean he'd have to sacrifice his profit margins to stay in the game.
I see. If he did an IPO, he wouldn't be his own boss anymore.
No, he'd answer to Wall Street.
He would spend the next 10 years of his life jumping on quarterly earnings calls with Wall Street analysts, constantly defending his shrinking margins, and fighting tooth and nail with a new board of directors who would inevitably demand he cut the customer service budget.
They'd cut the flowers immediately.
The very flowers and overnight shipping that made Chewy special in the first place. He was optimizing for freedom, not just the maximum possible vanity valuation.
A very mature decision for a 31-year-old.
So he takes the clean exit. At 31 years old, he personally walks away with hundreds of millions of dollars and total uncompromised freedom. Which brings us to what the author calls the autopsy of the retail apocalypse.
Right. After Buffett closed his partnerships in the late 60s, he spent the early 1970s just reading, observing, and studying businesses without the pressure to act.
The sabbatical.
Yes. This period of quiet reflection is when he had his famous epiphany about See's candies in 1971. He realized that the best investments aren't just cheap, failing companies with one last puff of profit, what he called cigar butts.
Right.
The best businesses are durable franchises with extreme pricing power. See's Candies could raise the price of their chocolate by 5% every single year, and customers didn't blink because they were buying a cherished Christmas tradition, not a commodity.
They weren't price shopping.
Exactly. Buffett learned that you pay a premium for the moat, and that moat allows the capital to compound forever.
So following that exact same pattern of taking a deliberate sabbatical to study the board, Cohen spends his post-Chewy years digging deep into SEC filings and financial reports.
Reading everything.
But instead of finding wonderful, durable businesses to buy, the author tells us Cohen found something horrifying. He started investigating the so-called retail apocalypse, this massive wave of legacy household name brands going bankrupt one after another.
The narrative we all know.
Right, the media narrative we all heard was identical every time. Amazon killed them, e-commerce ate their lunch, they failed to innovate.
It was a very clean, easy story.
But Cohen starts looking at the actual raw data, starting with Toys R Us. And what he finds completely shatters the media narrative. Walk me through the Toys R Us autopsy.
The Toys R Us bankruptcy is a foundational example of Sterling's central thesis about Wall Street predation. In 2017, when Toys R Us formally filed for bankruptcy, every financial news network ran the same headline. Amazon crushed them.
I remember that.
But Cohen pulls up the actual Chapter 11 bankruptcy filing and looks at the numbers. Toys R Us had generated $11.2 billion in top-line revenue the year before they died.
Wait, $11.2 billion in revenue?
Yes.
That doesn't sound like a company that people have stopped shopping at.
It's a staggering amount of money. That is not a dead business model. Millions of people were still walking into those stores and buying toys.
So what was the problem?
When Cohen looks at the balance sheet, he sees the real disease that killed the host. $5 billion in total debt, which required the company to pay $400 million a year just in interest payments.
$400 million a year, just to service the interest on the debt.
Just the interest.
It's not paying down the principal, that's just keeping the lights on. Where did a toy store acquire $5 billion of debt?
It didn't happen organically. It came from a 2005 leveraged buyout, or LBO.
Okay, unpack an LBO for me.
Sure. Private equity firms, specifically a consortium of KKR, Bain Capital, and Vornado Realty Trust, bought the company. Now, in a leveraged buyout, the buyers don't use their own cash for the whole purchase.
Right, they use leverage.
They only put up about $1.3 billion in equity. They financed the rest of the purchase by loading $5.3 billion of debt directly onto the Toys R Us balance sheet.
So they essentially used the company's own assets as collateral to buy the company,
Yeah.
and then stuck the company with the mortgage.
Precisely. And on top of that, These private equity firms extracted over $200 million in management fees out of the company over the ensuing years.
For managing its decline.
Yeah, think about the operational reality. When a retail company is bleeding $400 million a year just to pay interest to the banks, it has absolutely zero free cash flow left to modernize its physical stores, to build out a competitive e-commerce platform, or to improve the customer experience.
Can't compete because it's starved.
It is just slowly suffocating under the weight of debt it didn't ask for.
The book literally calls it financial homicide. And looking at those numbers, it's hard to argue. But he didn't stop with Toys R Us. Cohen looks at Blockbuster next.
Another classic example.
Now, I feel like everyone knows the Blockbuster story, right? It's the ultimate business school cautionary tale. Netflix streaming came along, Blockbuster laughed at them, failed to innovate, and died.
That's what they teach, yeah.
But wait, let's look at the actual data Sterling provides here. What was happening in 2007?
The 2007 data completely flips the conventional wisdom. In 2007, Blockbuster generated $5.5 billion in revenue.
Okay.
Netflix in that same year generated $1.2 billion.
A fraction of Blockbuster.
And remember the technological context of 2007, Netflix streaming barely even existed. It was a tiny experiment. Netflix was still primarily a DVD by mail service. Blockbuster's revenue was 4.5 times larger than Netflix's, just 3 years before Blockbuster filed for bankruptcy.
That's insane. So if streaming didn't kill him in 2010, what actually did?
Let me guess. Dead again. Dead again. When Viacom spun off Blockbuster into an independent company in 2004, it loaded Blockbuster with nearly $1 billion in debt, simply to finance a massive special cash dividend back to Viacom's own shareholders.
So they just extracted $1 billion and left Blockbuster holding the bag.
Exactly. That debt ate up roughly $80 million a year in interest payments. But the Blockbuster autopsy introduces the second major, deeply concerning factor in this pattern of failure, the role of elite management consultants.
Okay, yes, this part of the book blew my mind, because in 2009, as Blockbuster is struggling under this debt, they bring in the heavy hitters. Consulting firms McKinsey and Bain are brought in to advise the board.
The smartest guys in the room.
Right. And their grand expensive recommendation to save the company is to close 500 stores to focus on profitability and cost cutting.
Which is the exact opposite of what made the business work. What was Blockbuster's entire competitive moat? Convenience. They had a brightly lit store on almost every major corner in suburban America. Friday night, you drive 3 minutes, you grab a movie and some popcorn. If you systematically close those stores to save money on leases, the moat vanishes.
You break the habit.
The friction for the customer increases. And suddenly, they just switch to the red box kiosk outside the grocery store, or they sign up for Netflix by mail. The consultants recommended the one specific action that would systematically destroy the company's only competitive advantage.
It's baffling.
And this raises an incredibly uncomfortable question that the author tackles head-on. Why do these brilliant Ivy League-educated consultants do this?
Because it happens so often, it can't just be incompetence. And Sterling outlines a theory he calls the consultant death loop. Let's see if I can break down the perverse incentives he describes here.
See, do.
A struggling company hires a major restructuring firm. These firms charge massive upfront fees. The book notes that Alvarez and Marsal made $8 million just in upfront fees for the Toys R Us turnaround attempt.
Just to walk in the door.
And what is their playbook? It's always the same. They invariably recommend cutting physical stores, aggressively reducing inventory, and firing frontline staff to make the next quarter's balance sheet look slightly better.
Right. They optimize for the short-term accounting, not the long-term business.
But by doing that, they weaken the business's network effect and competitive advantage. The customer experience degrades, revenue inevitably drops further, the company goes into a death spiral, and inevitably files for Chapter 11 bankruptcy.
And here is the kicker. When the company goes bankrupt, who gets hired by the bankruptcy court to manage the liquidation of the assets?
The exact same consulting firms.
Yes.
Sterling notes that Alvarez and Marsal made an additional $28 million managing the Toys R Us bankruptcy liquidation. So they made $36 million in total for helping a historic American company die.
It's astounding.
So they get paid millions to write the prescription that inevitably kills the patient, and then they get paid tens of millions more to perform the autopsy and sell off the organs.
How's
That's structurally allowed.
It is a profound misalignment of incentives. But as we move into the next section of the book, which Sterling ominously titles The Plumbing of Corporate Murder, we discover that bad debt and parasitic consultants are only two heads of the hydra.
There's a third.
Cohen discovers there is a third element at play. And this is where the story shifts from bad corporate governance into something incredibly dark and systematic. The third head of the hydra is coordinated, predatory short selling.
Okay, let's take our time here because this gets highly technical and I want to make sure I'm following the mechanics. Short selling, in and of itself, is a normal legal market function.
Yes, perfectly legal.
If I think a company is poorly run, I borrow a share, I sell it at today's price, the stock drops, I buy it back cheaper, return it to the lender, and I keep the difference as profit. That's standard market pressure.
Correct.
But Sterling details a specific, highly exploitative mechanic known as the seller box.
No.
Can you explain this to me like I'm 5?
Let's break it down step by step. Let's say a hedge fund shorts a stock successfully. The company struggles. The stock price drops from $20 to $5.
Okay.
To actually realize that profit, the hedge fund eventually has to go into the open market, buy the shares back, and close the position. When they do that, they lock in their gains. But under U.S. tax law, the moment they close that position for a profit, they owe a 23.8% capital gains tax to the IRS.
Right. You make money, you pay taxes. Standard.
But what if you could avoid paying the tax entirely?
Oh, wow.
The seller box is a structural exploit. If a coordinated group of short sellers can drive the stock price down so far that it reaches fractions of, say, $0.0001 per share, the stock enters what traders call the cellar.
The bottom of the barrel.
At that price, it gets officially delisted from the major exchanges like the New York Stock Exchange or NASDAQ, and it gets relegated to trading on the over-the-counter pink sheets.
And what happens when it's in the cellar? Why is that a trap?
Once it's in the cellar, it gets boxed in by the mechanics of the bid-ask spread. Market makers essentially set the bid price what someone is willing to pay at zero. And they set the ask price, what someone is willing to sell for, at a microscopic fraction of a penny.
So there's a gap.
The spread becomes impassable. You literally cannot execute a trade. It is a mathematical prison for the stock.
So the stock is frozen at zero.
Yeah.
But wait, if the stock is frozen, how does the hedge fund buy the shares back to close their short position and take their profit?
That is the genius of the exploit. They don't buy them back.
What?
And here is the magic trick the author exposes, hinging on a specific piece of the tax code. IRS Section 1001. Under the section, a taxable event only occurs when a financial position is officially closed or settled.
Oh, I see where this is going.
If the stock is seller boxed and cannot be traded, the hedge fund simply never closes the position. They leave it open on their books indefinitely.
Let me see if I understand the horror of this. Because they never technically closed the trade, the IRS can't tax them.
Not a dime.
The massive profit they made driving the stock from $20 down to a fraction of a penny becomes completely permanent, and it is 100% tax-free.
Exactly. They use the unrealized tax-free gains as collateral on their balance sheets to leverage into new trades. They are financially incentivized not just to see a company decline or to force a turnaround. They are incentivized by the tax code to ensure the company is completely and utterly eradicated from existence.
But to achieve that level of total eradication, you need massive, overwhelming downward pressure on the stock price. You can't just short normally.
No, you need volume.
And that brings us to the concept of naked shorting and something called the obligation warehouse. Let's define naked shorting first. Normally, to short a stock, my broker has to locate a real share to borrow before I can sell it, right?
Correct. That's the locate requirement. Naked shorting is when a market participant sells a share short that they haven't actually located, borrowed, or secured.
Just invent it.
They just hit sell and create a digital IOU. This creates what the SEC calls a fail to deliver, or FTD. You sold something you didn't have, so when settlement day comes, you fail to deliver the share to the buyer.
And the SEC actually tracks this data. Sterling points out a terrifying statistic from the book. In the days before Sears finally went bankrupt, there were over 12.4 million shares that officially failed to deliver.
12.4 million.
That means 12.4 million phantom shares, shares that never existed, were dumped into the open market, massively diluting the supply and driving the price into the dirt.
It's artificial supply.
But my question is, where do these phantom shares go? They can't just float in the ether.
They don't vanish. The author explains that they are sent to something called the obligation warehouse. The obligation warehouse is a real system run by the DTCC, the Depository Trust and Clearing Corporation, which is essentially the central clearinghouse for all U.S. stock trades. You can think of the obligation warehouse as a massive, opaque digital filing cabinet. When a trade fails to deliver, the IOU gets stuffed into this cabinet.
And then what? Does the DTCC force them to buy the stock and clear the fail?
That's the terrifying part. No. There is no rigorous automated enforcement mechanism forcing the naked short seller to eventually go into the market, find real shares, and close the trade.
So they just sit there.
These failed obligations just sit there indefinitely. And if the target company eventually goes bankrupt and is seller boxed, the stock is canceled. All those phantom shares in the warehouse are essentially erased, and the naked short seller walks away with the cash they made from selling counterfeit shares, entirely consequence-free.
It's a license to print money.
It is an underlying infrastructure that appears custom-built to facilitate predatory naked shorting.
That is deeply unsettling. But if that wasn't concerning enough, Sterling takes us one layer deeper into the invisible plumbing, introducing total return swaps and this phenomenon he calls the zombie pulse.
The zombie pulse.
Let's start with what Cohen actually noticed on the charts. He saw something statistically impossible. Long dead, fully bankrupt companies like Blockbuster and Sears, whose stock was virtually worthless, completely delisted, sitting in the pink sheet cellar, were suddenly experiencing massive, violent price spikes.
Out of nowhere.
We're talking spikes of up to 700% on huge trading volume. And the kicker, these spikes were happening on the exact same day, sometimes the exact same minute, that GameStop stock was surging.
Right. A dead company with no stores, no revenue, and no press releases doesn't just randomly spike 700% on massive volume. It defies all basic market logic.
So how does the book explain that happening?
The author argues that this phenomenon mathematically proves the existence of algorithmic derivative baskets, specifically instruments known as total return swaps.
Okay, break that down for me.
Let me try to explain this without getting too lost in the financial jargon. Let's use an analogy. Imagine you want to bet against a horse in a race. Normally, you go to the track and place the bet. That's a standard short. But a total return swap is like going to a powerful bookie outside the track. You say, I want to bet against these 10 specific horses, but I don't want anyone at the track to know it's me.
Yep.
The bookie takes your money, creates a private contract with you, and then the bookie goes and places the bets to hedge their own exposure.
I follow that. The hedge fund doesn't hold the short directly. A major prime broker bank holds it for them via a swap contract, which hides the hedge fund's identity and hides the short position from public regulatory filings.
Exactly. Now, these banks don't just write a swap for one company. They bundle dozens of dying retail stocks, GameStop, Blockbuster, Sears, Toys R Us, into a single mathematical basket managed by an algorithm.
They're all tied together.
They are all mathematically linked together in this swap. Now, imagine what happens when GameStop's stock price unexpectedly starts to rise rapidly.
The algorithm panics.
Yes. The algorithm managing the bank's risk sees GameStop rising, which means the swap is losing money. To hedge that risk, the algorithm is programmed to automatically buy shares to neutralize the position.
Makes sense.
But because GameStop is mathematically bundled with Blockbuster and Sears in the same basket, when the code fires the command to buy GameStop, it accidentally sends buy signals for every other stock in that specific basket.
Oh my God. So by trying to cover their GameStop risk, the machines accidentally flooded the market with buy orders for dead companies. They shocked the corpses of Blockbuster and Sears back to life.
It's a literal zombie pulse, and Sterling argues it is the smoking gun. It mathematically proves that the short selling wasn't just individual traders making individual bets on bad companies. It was a coordinated, algorithmic, basketized system of destruction.
So synthesizing all of this, the author lays out what looks like the perfect crime. Let me summarize the Hydra.
Let's hear it.
You have short sellers creating infinite phantom shares and hiding them in opaque total return swaps to drive the price down. You have elite consultants infiltrating the company's board, charging millions of dollars to give restructuring advice that actively destroys the company's competitive moat from the inside.
Right.
And then there is a final piece of the puzzle. The financial media. According to the book, major financial media networks who rely heavily on massive advertising dollars from these very same hedge funds act as an amplification machine.
The narrative machine.
They constantly churn out negative articles about the retail apocalypse to ensure retail investors panic and sell, providing the necessary liquidity for the short sellers. It's a fully coordinated, self-sustaining system of corporate murder.
Which brings us perfectly to the turning point of the narrative, the declaration of war. Armed with this terrifying understanding of how the market actually operates, Cohen doesn't retreat.
He steps into the arena.
He decides to go on the offensive. He starts looking for a very specific target. He wants to find a company that is currently in the crosshairs of this exact machine, but hasn't fully died yet. A company he can intercept and rescue. In late 2019, his screening process flags GameStop.
In late 2019, the stock is trading at around $4 a share. The market cap of the entire company is roughly $280 million.
Tiny for a global retailer.
The media is screaming daily that it's the next blockbuster. The digital downloads will kill physical game discs. But Cohen ignores the media and looks directly at the 10K SEC filings. And he sees a completely different reality.
The hidden value.
He sees a company sitting on a gold mine of assets. They have $500 million in cash. They have $800 million in physical inventory. They have massive real estate value tied up in 5,500 store leases. They own Game Informer magazine. And they have 50 million deeply loyal customers in their Power Up Rewards program.
And most importantly, returning to the lessons of his autopsy phase, GameStop had no private equity debt bomb.
No LBO.
No LBO had hollowed them out. The balance sheet was relatively clean. It wasn't structurally flawed. It was just a lazy, poorly managed company that had failed to adapt.
But the predators were already circling, right? The machine had already targeted them.
Absolutely. The percentage of publicly tradable shares that had been sold short was sitting at 71% and climbing rapidly. And almost comically predictably, the GameStop board of directors had just announced they were hiring a major consulting firm, Boston Consulting Group, or BCG, to conduct a strategic review.
The consultant death loop begins.
Precisely. Cohen knew exactly what was going to happen next if he didn't intervene immediately. The consultants would recommend closing stores, the revenue would drop, the shorts would pile on, and the seller box would snap shut.
What does he do?
So he starts quietly using his personal Chewy fortune to buy the stock. Millions of shares. By August of 2020, he has accumulated nearly 10% of the entire company.
And he does not play nice. He doesn't ask for a polite introductory meeting over coffee with the CEO. The book describes how he channels his inner Warren Buffett, specifically the ruthless 1965 Buffett, who executed a hostile takeover of the original Berkshire Hathaway textile mill.
The activist phase.
Cohen files a public 13D letter with the SEC. And reading the excerpts of this letter, it is a surgical, deeply aggressive 9-page document that publicly humiliates the board.
He didn't pull any punches.
He calls them out for internal intransigence. He basically says you are sitting on the assets to be a digital powerhouse, but you are failing spectacularly. Give me a seat at the table to fix this, or I'm going to launch a hostile proxy war, take this to the shareholders, and take your jobs.
A shot across the bow.
He attaches it to a public SEC filing, hits send, and the war officially begins.
The old guard fought back initially, but they couldn't argue with his track record at Chewy or his massive ownership stake. By December of 2020, the board completely capitulates.
Crippled.
They agreed to expand the board and give Cohen and 2 of his most trusted Chewy allies seats. And the moment he steps into his very first official board meeting in January 2021, Cohen takes immediate, lethal aim at the consultant death loop.
I love this part. He demands to know exactly what the company has gotten for the $30 million they have already paid to Boston Consulting Group.
For the strategic review.
Right. The old CEO nervously pulls up a 73-slide PowerPoint deck that BCG had produced. And what is the grand recommendation for their $30 million? The deck recommends closing 1,200 stores.
Cohen immediately recognizes the exact playbook that killed Toys R Us and Blockbuster. He sees the death spiral forming. He doesn't ask for further studies. He forces an immediate board vote.
Cut out the cancer.
Within 24 hours of officially taking power, he fires the consultants, severing the first head of the Hydra before it can lay its eggs.
Then comes the internal culture war. He purges the old board members, the ones who had no real skin in the game and were just collecting 6-figure board fees. He brings in Matt Furlong, a high-level operational executive from Amazon, to be the new CEO.
A logistics guy.
And Sterling describes Matt Furlong's very first all-hands meeting at the corporate headquarters. It sounds absolutely brutal. Furlong stands in front of 450 comfortable corporate employees and projects a recent internal email thread on the screen.
Oh, this is a great anecdote.
17 different middle managers spent 6 full days replying to each other just to decide whether to change the color of a banner on the website.
6 days.
Furlong looks at the room and tells them that at Amazon, a decision like that takes 6 minutes. He introduces Amazon's leadership principles, bias for action, extreme customer obsession, and then he drops the absolute hammer on their compensation packages.
This was the moment the culture definitively shifted. Furlong announced that from that moment on, all executive compensation would be radically changed. The bloated base salaries were gone. The guaranteed annual cash bonuses were gone. And perhaps most shockingly, the golden parachute severance packages were completely eliminated. It was going to be a pure meritocracy. Executives would be paid almost entirely in restricted stock.
So if the stock goes down to zero, the executives literally get nothing for their time.
Exactly. But if they turn the company around and the stock succeeds, they become incredibly wealthy. They had to put their own financial well-being on the exact same side of the table as the everyday shareholders.
Skin in the game.
Furlong essentially told everyone in the room that if they were there just to collect guaranteed cash while the ship sank, they should pack their desks and leave immediately.
And what happened?
Within months, the corporate headcount at headquarters was slashed by 50%. The mercenaries, the people just there for a paycheck, left, and the people who stayed were the owners, the people willing to bet on themselves.
Okay, so Cohen has seized control of the board, fired the consultants, and completely re-engineered the corporate culture. She's doing the grueling operational work.
The internal turnaround.
But we have to talk about what was happening simultaneously in the outside world. Because while Cohen was doing all of this behind closed doors, something explosive, something historic was brewing in the public markets. We have to dive into the January earthquake.
The short squeeze.
And to do that, we have to talk about Roaring Kitty, also known as Keith Gill. Gill was a retail investor, a guy in his basement who saw the exact same deep value play that Ryan Cohen saw way back in 2019.
He was incredibly early.
Gill turned a $53,000 options bet into $1.5 million just by being early, seeing the math, and having the conviction to hold on.
Gill was instrumental because his deep dive analysis, which he freely shared on Reddit's Wall Street Bets forum and YouTube, helped to crowdsource the discovery of a terrifying mathematical impossibility. By late 2020, the short interest in GameStop, the data reported by the exchanges, had reached 140% of the total tradable float.
Wait, stop. Explain that. How can you short 140% of a company? That means you've sold more shares than physically exist. If a company issues 100 shares, how can 140 be sold short?
It comes back to the naked shorting and a practice called rehypothecation, where the same borrowed share is lent out multiple times to different short sellers. The mechanics are complex, but the mathematical reality was simple. Hedge funds had sold short 40% more shares than actually existed in the world.
That's insane arrogance.
They were so utterly convinced that GameStop would go bankrupt, that the consultants would ruin it, and that the stock would be permanently seller-boxed, that they abandoned all basic risk management. They got greedy, and in doing so, they created a mathematical guarantee of a massive short squeeze if the company simply managed to survive.
And when millions of retail investors on Reddit realized this vulnerability, they didn't just buy the stock to hold it. They bought call options. And this triggers a market mechanic that the author describes as the gamma ramp. I need you to break down exactly how options and delta hedging created this explosion.
Absolutely. When a retail investor buys a call option, they are buying the right to purchase the stock at a certain price in the future. But they buy that option from a market maker, a massive financial institution that facilitates trades.
Okay.
Now, market makers are supposed to remain neutral. They don't want to bet against the stock going up or down. So when they sell you a call option, they take on risk. To neutralize or delta hedge that risk, the market maker goes into the open market and buys a certain number of the underlying shares.
Okay, so I buy an option. The market maker is forced to buy real shares to cover themselves.
Precisely. Now imagine millions of retail investors buying call options all at once. Market makers are forced to aggressively buy millions of real shares to delta hedge. This massive buying pressure drives the stock price higher.
Which pushes the options into the money.
Exactly. As the stock price goes higher, those call options get closer to being profitable or in the money. When options get closer to being in the money, the mathematical risk to the market maker increases, which forces them to buy even more shares to hedge the new risk.
Oh, I see it. It's an explosive, self-sustaining feedback loop. Retail buys options, market makers are forced to buy shares, which drives the price up, which forces the market makers to buy even more shares, which drives the price up again, trapping the original short sellers in a nightmare scenario.
Exactly. It is a gamma ramp. And by late January 2021, that loop was ripping the fabric of the market apart. Which brings us to January 28th, a day that will forever live in financial infamy.
The day they turned off the buy button.
In the pre-market trading hours, GameStop hit $513 a share. The hedge funds who were short 140% of the float were facing absolute, unmitigated annihilation. Trillions of dollars of risk were suddenly exposed. And then the unthinkable happened. Retail brokerages, most notably Robinhood, but several others as well, simply turned off the buy button.
It is still shocking to think about. Even years later, in a supposedly free market, they literally just unplugged the controller for the retail players.
They locked them out.
Everyday investors could only hit sell to close their positions. They could not hit buy. Meanwhile, institutional investors, hedge funds, and market makers could still trade freely among themselves. With the buying pressure artificially and instantly eliminated, the stock crashed 58% in just 35 minutes.
A total collapse.
It was a devastating, deeply controversial blow to retail investors. But what is truly fascinating to me is what Ryan Cohen was doing while the financial world was literally burning down around him. While Congress was calling hearings, while the SEC was panicking, what was he doing?
He was doing absolute nothing publicly. No angry tweets about the unfairness of the market, no appearances on CNBC to defend the stock, no fiery press releases, complete, absolute radio silence.
Why? Why not defend your investors?
Sterling argues that Cohen's silence was his greatest weapon. He didn't get caught up in the emotional media narrative of the squeeze or the outrage over Robinhood. Instead, he coldly recognized the incredible strategic opportunity that the inflated stock price presented to the business itself.
The capital raise.
While the media was screaming about meme stocks, Cohen quietly executed a series of at-the-market, or ATM, share offerings. He sold a small percentage of new corporate shares directly into the massive market demand, raising $1.7 billion in pure cash for the company treasury.
He used the short sellers' favorite weapon, dilution, against them. They rely on diluting a company with phantom shares, so he diluted them with real shares to take their cash. And what did he do with that $1.7 billion?
He immediately paid off every single penny of GameStop's long-term debt. And in doing so, he mathematically deleted the short sellers' only exit strategy.
The seller box.
Remember the seller box. Their entire thesis, their entire multi-billion-dollar bet, relied on GameStop eventually running out of cash, defaulting on its debt, and going bankrupt. By clearing the debt entirely and hoarding $1.3 billion in cash, Cohen made the company essentially unkillable. The shorts were now permanently trapped in a company that literally could not go bankrupt.
It's a masterstroke. Having completely secured the fortress and eliminated the existential threat, Cohen moves to the final act, which Sterling outlines in Section 6, building the cathedral. The financial media continued to obsess daily over the fluctuations of the meme stock, treating it like a joke.
They completely missed what was happening internally.
But Cohen ignored the ticker and focused on deploying that massive pile of capital. He began building a massive modern fulfillment empire to rival Chewy and Amazon.
The operational pivot was staggering. Within a year, they secured 2.9 million square feet of brand new state-of-the-art warehouse space across 4 megacenters. They'd expanded their product catalog from a paltry 5,200 physical items to over 55,000 SKUs, pushing aggressively into high-margin PC gaming equipment, consumer electronics, and rare collectibles.
And they took their greatest legacy liability, their 4,000 physical retail stores inside dying malls, and turned them into a massive asset. They converted them into micro-fulfillment centers.
Brilliant logistics.
They partnered with gig economy networks like DoorDash and Uber to offer same-day delivery from the local store directly to your house. In many cases, they were beating Amazon's delivery times because Amazon doesn't have a physical staging ground in every single zip code in America. But then, amidst all this brilliant logistical maneuvering, Cohen makes a move that completely baffled the media and the traditional Wall Street analysts. The NFT gambit.
Yes, this is perhaps the most misunderstood part of his entire strategy. Launching a Web3 NFT marketplace in the middle of 2022, right as the crypto winter was freezing the market, seemed like corporate suicide to the outside world.
Everyone was mocking them.
The media was dancing on the grave of digital ape JPEGs, declaring the whole underlying technology a massive scam. But Sterling's book makes it incredibly clear that Cohen wasn't interested in speculative art or overpriced JPEGs. He was looking at a $50 billion market that already existed right under everyone's noses, the video game skins market.
Let's really unpack this $50 billion market. Because if you aren't a gamer, you might miss how massive this is. If you look at massively popular games like Fortnite, Counter-Strike, or Roblox, players are spending billions upon billions of dollars every year on digital outfits, weapon skins, and cosmetic items for their avatars.
It's a huge economy.
But they don't actually own any of it, right? If they stop playing the game, or if the developer decides to ban their account, that money is just vaporized. They can't take that rare digital sword and resell it on an open market to recoup their investment. It's a closed, walled garden ecosystem controlled entirely by the corporate game developers.
Exactly. The player spends real money but gets no actual property rights. Cohen's core thesis was that this system is unsustainable and that the concept of true digital ownership is inevitable. The players will eventually demand to own what they buy.
It's the natural progression.
To prepare for this massive paradigm shift, GameStop quietly partnered with Layer 2 blockchain solutions, specifically companies like Immutable X and Loopring.
Explain Layer 2 to me, because people always complain about how expensive crypto transactions are.
That's exactly why Layer 2 is crucial. If you try to execute a transaction on the main Ethereum network, Layer 1, it requires massive computational power, resulting in gas fees that can sometimes cost $50 or $100 just to process a single trade.
Nobody is paying $50 to trade a $2 skin.
If you want to buy a $2 digital sword in a video game, you obviously can't pay a $50 transaction fee. It breaks the economy. Layer 2 networks act as an expressway built on top of Ethereum. They bundle thousands of transactions together off-chain, process them in bulk, and then secure them on the main chain.
Oh, clever.
By doing this, they drop the transaction fees down to fractions of a penny, making high-volume, low-value in-game trading economically viable.
So they solved the plumbing issue. And then they started bringing in established Web3 games like Gods Unchained to populate the marketplace.
Yeah.
Now, the media laughed at GameStop because the early trading volumes on their NFT marketplace were low compared to the peak insanity of the 2021 crypto bubble.
They were measuring the wrong metric.
But Sterling argues they completely missed the point of what Cohen was doing. He wasn't building a marketplace to capture the speculative hype of 2022. He was building the foundational plumbing for 2032.
A 10-year bet.
He is making a massive bet that within a decade, gaming will be 100% digital, and players are going to demand true, provable, blockchain-backed ownership of the billions of dollars they spend. And when that consumer demand inevitably hits critical mass, GameStop will already have the marketplace, the legal infrastructure, and the developer partnerships fully in place to collect a fee on every single transaction.
Which brings Sterling's entire analysis to its grand sweeping conclusion, the Berkshire parallel. We started this deep dive an hour ago comparing a young Ryan Cohen to a young Warren Buffett. The author solidifies this not just as a thematic comparison, but as a deep structural and mathematical comparison. Think about how Berkshire Hathaway actually operates. How does it compound wealth so reliably year after year? Buffett relies on something called insurance float, the billions of dollars in premiums collected by GEICO and his other insurance companies before claims ever need to be paid out.
It's essentially free money to invest.
He uses that $150 billion in float as patient permanent capital. He uses that free cash to invest in other businesses for the long term, completely ignoring the quarterly earnings pressure from Wall Street analysts, because it's his own internal capital.
And Sterling's thesis is that Cohen is doing the exact same structural thing, just utilizing a different mechanism. GameStop obviously doesn't have insurance float, but because of the short squeeze in the ATM offering, it has a debt-free $1.3 billion cash fortress.
That is his float.
That cash is Cohen's float. The interest alone on $1.3 billion in today's Treasury yields covers the operating losses of the legacy retail business. It allows him to build massive logistics infrastructure, to experiment with Web3 technologies, and to play a 10-year-long game without ever having to appease a Wall Street analyst begging for a quick stock buyback every 90 days.
And Sterling leaves us with a profound timeline comparison to keep everything in perspective. In 1965, Warren Buffett executed his takeover of Berkshire Hathaway. 7 years later, in 1972, the company was still just a struggling, cash-burning textile mill in New England.
It took time.
It took 59 years of ruthless patience and compounding to become the $930 billion global behemoth it is today. Ryan Cohen, as of the writing of this book, is only in year 4 of his transformation of GameStop. He has completely secured the capital, he has ruthlessly transformed the culture, and he has built both the physical logistics and the digital Web3 infrastructure. The foundation is built. The cathedral has just begun to rise.
So after diving through all of this, the dog food logistics, the predatory consultants, the seller boxing, the short squeezes, what does this actually mean for you? As a listener, navigating a modern world that is completely obsessed with instant gratification, focused entirely on quarterly earnings reports, and addicted to the daily dopamine hit of checking a stock ticker on your phone, the story of Ryan Cohen and GameStop is a masterclass in the profound, almost unstoppable power of patient capital.
It really is.
It forces you to step back and ask yourself a serious question. Whatever it is you are building in your life, your career, or your portfolio, are you building it for the temporary applause of the next quarter, or are you doing the hard, unglamorous work of building a foundation that will reliably compound for the next 50 years?
And if we connect this incredible corporate turnaround back to the bigger picture of the global financial markets, Sterling's book leaves us with a final, highly provocative thought to mull over. We have just spent the last hour detailing how a decentralized, highly motivated group of retail investors on Reddit successfully crowdsourced the discovery of a 140% short interest.
They did the work.
They crowdsourced the discovery of the seller boxing mechanics, the IRS loopholes, and the algorithmic total return swaps. They essentially peeled back the curtain and exposed the inner workings of Wall Street to the public.
Right. They shined a massive spotlight on a machine that was designed to operate entirely in the shadows.
Exactly. So the lingering billion-dollar question that the author leaves us with is this: what happens to Wall Street's invisible plumbing over the next decade? Because of GameStop, you now have a newly educated, highly skeptical, and deeply connected generation of millions of retail investors. What happens when this massive, decentralized hive mind applies this exact same forensic level of deep dive research to other supposedly dying companies? It could change everything.
If the entire infrastructure of predatory finance, the naked shorting, the swap baskets, the consultant death loops, relies fundamentally on operating in the dark, staying completely invisible to the general public, what happens to that system when millions of everyday people suddenly know exactly how to turn on the lights?